Every person who opens a trading platform believes they are making intelligent decisions. They believe they are analyzing the charts, weighing probabilities, and acting like professionals. But if you strip away the surface, if you zoom into their behavior, most are not traders at all. They are gamblers dressed as traders. They click buttons not because they have a clear edge, but because they hope the market will reward them. They don't manage risk like a business. They bet like someone at a roulette table who convinces themselves that their number is due. The difference between a gambler and a professional trader is not the charts, not the tools, not the market, it's psychology. And more specifically, it's the psychology of risk. A gambler treats risk as something to be avoided, something to be feared, something that should hopefully not appear. A professional trader treats risk as the very foundation of their business. They embrace it, study it, price it, and build systems around it. If you want to survive in trading, you must stop thinking like the gambler who needs to win today and start thinking like the casino that knows the house edge will pay them tomorrow. The truth is, casinos do not fear gamblers. In fact, they welcome them. They spend billions designing rooms with flashing lights, free drinks, and no clocks to keep players glued to the tables. Why? Because they understand probability better than anyone else. A gambler might hit a lucky streak, but the casino knows that over thousands of rolls, spins, and hands, the odds are fixed in their favor. They don't care about one outcome. They care about the long series of outcomes. And because of that, they win every single year. The gambler plays with emotion. The casino plays with math. The gambler bets hoping for luck. The casino profits from patience and discipline. Now let's apply this to trading. When you take a trade because the chart looks good, or because you feel confident, or because the last one worked out, you're gambling. You're reacting emotionally, without a defined edge. You might win in the short run, but over time, you will lose. Why? Because like the gambler, you have no house advantage. On the other hand, when you develop a strategy with a clear edge, test it, refine it, and then execute it with consistency, you start to become the casino. You don't know if the next trade will win or lose, but you know that across 100 trades, your edge will show. That is how professionals think. The danger is that most traders never make this shift. They are too caught up in the illusion of control. They believe they can predict the next candle, the next move, the next breakout. But prediction is gambling. Probabilities are trading. Casinos don't predict which spin of the roulette wheel will hit red or black. They simply know that in the long run, the green zero tilts the odds in their favor. Traders must learn to think the same way. Not about the next trade, but about the next 100. Not about being right, but about being consistent. One of the most dangerous illusions gamblers and traders fall into is the belief in streaks. If they win 3 times in a row, they think they are hot. If they lose 3 times, they believe they are due for a win. Both are lies. Each roll of dice, each spin of the wheel, each independent trade is just that, independent. The market does not remember what happened yesterday. Yet traders chase revenge trades, double their size after losses, or let euphoria cloud their judgment after wins. That's gambler psychology at its purest. The casino never chases. The casino never doubles down emotionally. The casino sticks to the math, because the math never lies. And here is the brutal truth. The market is the casino. Every time you place a trade without an edge, you are the gambler, and the market is the house. That's why most traders lose. They are walking into the casino thinking they can outsmart it with intuition, and they get chewed up over time. To flip this, you must adopt the market's perspective. You must design your own edge, your own small advantage, and then repeat it relentlessly with discipline. That is how you stop being the gambler and start becoming the house. Consider how casinos survive losing streaks. A player might sit down and win $50,000 in a single night. Does the casino panic? Because they know that across thousands of players, across millions of hands, their edge guarantees profits. Now compare that to the average trader. One losing day, and they spiral. One bad trade, and they question their whole system. That fragility is why they fail. A professional trader understands that a loss is just one spin of the wheel. It means nothing compared to the overall game. That mindset of thinking long-term, of trusting the edge, is what keeps them alive. Before we dive deeper, let me ask you this. Are you struggling with fear, doubt, or overtrading? The truth is, most traders don't fail because of bad strategies. They fail because of bad psychology. That's why I created my ebook, Master Your Mind, Master Your Trades. It's packed with practical steps to control your emotions, stay disciplined, and trade like a pro. If you're ready to take your trading to the next level, check the link in the description and pinned comment, and grab your copy today. Now let's continue. There's another hidden truth in how casinos think. They cap risk. They set table limits. They make sure no gambler can walk in and place a bet big enough to bankrupt them. Yet how many traders blow their accounts because they risk too much on a single trade? They act like gamblers going all in on one hand, forgetting that survival is the real goal. The casino doesn't gamble its survival, it manages it, and so must you. Every trade you take should be sized so small that even 10 losses in a row won't destroy you. That's what risk psychology looks like in action. And here's something even more profound. Casinos don't chase players. They don't beg gamblers to come back after losing. They wait, because they know the odds will always pull players back eventually. Traders must learn the same. You don't chase the market when you miss a move. You don't beg for opportunities. You wait patiently for your edge to appear. Because if your system is real, the opportunities will always come. Trading, at its core, is not about being smart enough to outwit the market. It's about being disciplined enough to play the role of the house, not the gambler. The gambler believes each moment is life or death. The casino knows the only thing that matters is the series. The gambler panics after losses. The casino shrugs. The gambler wants quick results. The casino thinks in decades. This is the psychology of risk that separates amateurs from professionals. And if you doubt this, look at your own history. How many times did you lose not because your analysis was terrible, but because you sized too big, acted too fast, or tried to predict instead of waiting for your edge? How many times did you act like a gambler, hoping the market would bless you, instead of like a casino, managing your risks and waiting for probabilities to play out? The truth is painful but freeing. You've been gambling more than trading, and the moment you admit that, you have the chance to change it. So here's the shift. Stop thinking about the next trade as a lottery ticket. Start thinking about the next 100 trades as your casino floor. Each trade is one spin, one roll, one hand. Some will win, some will lose. But if you have an edge, and the patience to execute it, the house always wins. You must build yourself into that house. And when you finally grasp this, you stop fearing losses. You stop chasing wins. You stop living trade to trade. Instead, you start building like a casino, steady, disciplined, unemotional, with patience as your weapon and probabilities as your edge. And that is the first step in mastering the psychology of risk. If you've ever stepped into a casino, you've probably felt the energy in the air. The lights are dazzling, the machines flash and sing, people shout in excitement at the craps table, and every detail feels like you're walking into a place where dreams can come true. It looks like the perfect environment for wealth, but stay long enough, and you begin to notice a different pattern. Players walk in full of confidence, they play, they laugh, they cheer, and most of them walk out with less money than they arrived with. They don't just lose because they made a bad decision on one spin or one card. They lose because the entire system is designed for them to lose. The casino, on the other hand, doesn't need to get lucky. The casino doesn't panic when someone wins big. It doesn't flinch when a gambler hits a jackpot. Because the casino knows something most people refuse to accept. If you keep playing long enough, the house always wins. This is the same dynamic at play in trading. Every day, millions of people sit at their computers, open up their trading platforms, and believe they're different. They tell themselves they're not gamblers. They're traders. They've studied charts, they've watched videos, they know what they're doing. Yet the outcome is eerily similar to the casino floor. Most of them leave the game with less than they started with. Their accounts slowly bleed down, their confidence collapses, and eventually, many give up entirely, muttering the same excuse gamblers use. It was just bad luck. But it wasn't bad luck. It was bad psychology. Because without realizing it, they walked into the markets with the same mindset gamblers carry into casinos. And just like gamblers, they were doomed from the start. The first mistake gamblers make, and the same mistake traders repeat, is the illusion of control. A gambler sits at a slot machine and believes that after 5 spins with no win, the 6th must be lucky. A trader watches the market fall for 3 days and convinces themselves that the 4th day must reverse. Both are trapped by the same faulty logic, ignoring the reality that each event is independent of the last. Probability doesn't care about streaks. A coin flipped 10 times that lands on heads every time doesn't make the 11th flip more likely to be tails. The odds reset every single time. Yet gamblers and traders trick themselves into believing patterns exist where none do. That false sense of control makes them reckless, doubling down on bad bets and throwing good money after bad trades. They don't realize they've stepped into a game they cannot win, because they've surrendered to psychology instead of discipline. The casino knows this better than anyone. It doesn't need to know what card will come next or where the roulette ball will land. It doesn't waste energy trying to predict every outcome. Instead, it builds its empire on probabilities. Every single game on the floor, whether it's blackjack, poker, or roulette, has a built-in edge. That edge may seem small, maybe just 2 or 3%. But over thousands and millions of plays, it guarantees profit. That's why casinos don't need to panic when someone walks out with a jackpot. They know that over time, the numbers always swing back in their favor. And this is exactly the way a trader should think. The goal is not to win every trade or to predict every move. The goal is to develop a system where, over a long enough series of trades, the probabilities tilt in your favor. If you think like the gambler, you focus on the next spin, the next hand, the next trade. If you think like the casino, you focus on the next 1,000. But traders rarely do that. Instead, they chase the same rush gamblers crave. And here's the brutal truth about gambling. It's addictive not because of winning, but because of uncertainty. Neuroscience shows that the brain releases dopamine not when we receive a reward, but when we anticipate one. The thrill of maybe winning is stronger than the satisfaction of actually winning. That's why gamblers keep pulling the lever, even when they're losing. And that's why traders keep clicking buy and sell even when they don't have a valid setup. They're not trading because they've found an opportunity. They're trading because their brain is addicted to the thrill of possibility. The flashing charts, the ticking numbers, the sudden surges of price, it's the market's version of casino lights and spinning reels, and traders, like gamblers, fall for it every time. This is why overtrading is so common. A gambler doesn't go into a casino planning to sit for 10 hours, but once they're there, they can't stop. A trader doesn't open their laptop planning to take 15 trades in a day, but as soon as they're in front of the charts, they can't resist. Every movement feels like an opportunity. Every candle feels like a chance to win. But what they're really chasing is not money. It's the dopamine hit of uncertainty. The market becomes their slot machine, and just like the slot machine, it slowly empties their pockets. Then comes the dangerous belief in the big win. Ask any gambler and they'll tell you their plan. Hit one big jackpot and then quit. Traders say the same thing. Just one huge trade, double the account, and then walk away. But it never happens. Because when the gambler wins, they don't leave. They believe they're on a roll, so they stay until the house takes it back. And when the trader hits a big win, they don't cash out. They feel invincible, so they keep trading until the market humbles them. On the other side, when they lose, they don't quit either. They convince themselves the next hand or the next trade will fix everything. They chase losses, digging themselves deeper into a hole. Hope becomes their strategy, and hope is the fastest road to ruin. There's a concept in mathematics called gambler's ruin, and it perfectly explains why traders fail. If you play a game with negative odds long enough, you will eventually go broke. It doesn't matter how big your wins are in the short term. The longer you play, the closer you come to zero. This is the trap most traders fall into. They risk too much on a single trade, they keep trading without an edge, and they expose themselves to inevitable ruin. The professionals, on the other hand, understand the secret: survival. Trading isn't about making money fast. It's about staying in the game long enough for probabilities to work in your favor. The casino never bets so much that a single loss can destroy it. Professional traders do the same. They never risk so much that one trade can wipe them out. That's the difference between a gambler's mindset and a casino's mindset. Here's the irony. Many traders come into the markets convinced that they're not gamblers because they've studied charts, indicators, and strategies. They see gamblers as reckless people chasing luck, while they see themselves as disciplined students of the market. But in practice, they behave the same way. They abandon their rules after a loss, they double their risk to chase what they've lost, they trade out of boredom, and they convince themselves that luck is on their side. They may not be pulling a lever at a slot machine, but they're still sitting at the table, playing a game they don't understand, against an opponent that doesn't care about their feelings. And like gamblers, they eventually learn the same painful lesson. Without discipline, you cannot win. The shift from gambler to casino is not about knowledge, it's about psychology. It's about seeing trading not as an event, but as a process. The gambler thinks in terms of today, I need to win now. The casino thinks in terms of forever, over 1,000 plays my edge will show. The gambler stakes everything on hope. The casino relies on math. The gambler prays for luck. The casino doesn't need luck. And the market, just like the casino, rewards those who think in probabilities, not fantasies. So the question becomes, when you sit down to trade, whose psychology are you adopting? Are you entering the market with the mindset of a gambler, chasing thrills, addicted to uncertainty, hoping for a miracle? Or are you stepping in like a casino, calculating your risk, accepting your losses, and letting probabilities compound over time? The difference is everything, because one side always loses, and the other side always wins. Every trader who sits in front of a chart wants the same thing: control. The feeling that with enough effort, enough study, enough focus, they can predict what will happen next. It's a comforting idea, isn't it? That with the right strategy, the right indicator, the right guru whispering in your ear, you can finally bend the market to your will. But here's the brutal truth. Control in trading is an illusion, and the more you cling to it, the more the market will punish you. Gamblers fall for this trap every day. A man at a roulette table believes that because black has hit 5 times in a row, red is due. He piles his chips on red with confidence, believing that the wheel owes him balance. But the wheel owes him nothing. Each spin is independent. Each outcome is random within the house's edge. His belief in control is a fantasy, and the casino quietly thanks him for his donation. Traders make the same mistake when they convince themselves they can predict the next candle. They stare at a chart, draw their lines, adjust their indicators, and believe they've cracked the code. But the market doesn't care about their lines. The market doesn't care about their indicators. Price will go where it goes, regardless of how badly you want it to move in your direction. Just like the roulette wheel, every trade is an independent outcome within the broader edge of probability. The belief that you can force it, that you can know for sure, is the very thing that blinds you. Think about how many times you've been in a trade, and the market started moving against you. What did you do? If you're like most traders, you didn't calmly accept your stop loss. You adjusted it. You widened it. You convinced yourself the market would come back. You were so sure that your analysis was right, that you refused to admit the truth. You were wrong. That refusal to accept reality is the illusion of control in its purest form. Instead of managing risk like a casino, you gambled more chips on the table, believing you could bend probability with sheer willpower. And just like the gambler at the roulette wheel, you paid the price. The illusion of control is powerful because it feeds the ego. When you win a trade, you tell yourself it's because of your skill. When you lose, you blame bad luck. But the truth is often the opposite. Many of your wins came from random market movement that happened to go in your favor. Many of your losses came from decisions you made under the spell of your own certainty. You didn't just lose because the market turned. You lost because you couldn't let go of the need to be right. And that need to be right is exactly what destroys accounts. Professional traders understand something amateurs don't. The market is bigger than them. They don't try to predict every move. They don't fight the tape. They don't cling to trades out of stubbornness. Instead, they submit to uncertainty. They accept that they cannot control the outcome of any single trade. What they can control is their process. They can define their risk, manage their position size, and stick to their system. That is the only control that exists in trading, the control of yourself. Everything else is noise. But most traders don't want to hear that. They want certainty. They want to feel like gods sitting on top of the market, bending it with their knowledge. That's why so many traders jump from strategy to strategy, indicator to indicator, guru to guru. They're chasing the illusion of control, believing that somewhere out there is a magic formula that will finally give them certainty. But here's the truth. If you're looking for certainty, you're not looking for trading. You're looking for gambling. Because trading is not about certainty. It's about managing uncertainty. Consider the casino again. Does it know which spin will land on red or black? Does it care? Absolutely not. Because it doesn't need control over each spin. It only needs control over the math. Over time, the edge plays out. The casino accepts that randomness is part of the game. It doesn't fight it. It doesn't panic when luck swings against it. It simply plays the long game. And that's why it always wins. Now compare that to the average trader. The average trader panics at randomness. A single loss makes them question their system. A string of losses makes them abandon it completely. They scramble for new strategies, new tools, new predictions. They can't accept that randomness is part of the game. They can't stomach uncertainty. And because of that, they never last long enough for probabilities to work in their favor. They blow up before the edge has a chance to save them. The illusion of control shows up in more subtle ways too. It's not just about refusing to take a loss, it's about how traders interpret everything. A candle forms, and suddenly it means something. A line is drawn, and suddenly it's destiny. A moving average crosses another, and suddenly it's a prophecy. Traders assign meaning to random noise, convincing themselves they've discovered patterns where none exist. The market becomes a mirror reflecting their own biases, and they see what they want to see, not what's actually there. This false sense of certainty pushes them to risk too much, too often, on setups that aren't real. They think they're making informed decisions, but in reality they're just dressing up their gambling with technical jargon. The market punishes this arrogance with brutal efficiency. Because the truth is, every trade carries uncertainty. No matter how strong your setup, no matter how clear the chart looks, there is always a chance you're wrong. And if you build your trading around the illusion that you can be right every time, the market will break you. But if you build your trading around the reality that you don't need to be right every time, that you only need to manage risk and let probabilities play out, you step into the mindset of the casino. And that's where survival and eventually profitability begins. So let's ask a hard question. Are you a trader who seeks control, or a trader who manages uncertainty? When you take a trade, are you secretly hoping you can bend the market to your will, or are you calmly accepting that the outcome is out of your hands? The answer matters more than you think, because as long as you cling to control, you will suffer the fate of the gambler. You'll chase losses, you'll overtrade, you'll blow accounts. But the moment you release control, when you finally accept that your only power lies in discipline, patience, and probability, that's when you cross the line from gambler to professional. And here's the paradox. The moment you stop trying to control the market is the moment you gain control over your results. Not because you can predict what will happen, but because you no longer need to. You don't need every trade to win. You don't need the market to move your way. You only need to follow your edge and let time do the rest. That's the quiet confidence of the casino. It doesn't rush. It doesn't panic. It doesn't chase. It just plays its edge, over and over, until the math makes it rich. So the next time you sit down at your charts, ask yourself this: am I here to control the market, or am I here to manage myself? Because the market doesn't care about your predictions. It doesn't care about your feelings. It doesn't care about your need to be right. But it will reward the trader who accepts uncertainty and plays the game like the house. The market is the biggest casino in the world. The question is, are you walking in as the gambler or as the house? Trading is a strange game because it doesn't feel like business most of the time. It feels like combat. It feels like you're stepping into a ring where every move you make has the potential to either raise your heart rate with excitement or crush your confidence with defeat. But beneath all of that noise lies something more fundamental: risk. And the way you think about risk is ultimately the difference between being a casino and being a gambler. The truth is, most traders lose because they misunderstand risk. They think of it as something that can be avoided, something that can be outsmarted with enough technical indicators, enough YouTube strategies, or enough screen time. They treat risk like a villain, something to be feared, dodged, and eliminated. But risk isn't the enemy, it's the entire game. Without risk, there's no reward. Without risk, there's no opportunity. Without risk, the market wouldn't exist. Casinos understand this. That's why they don't get emotional when a gambler wins big. If someone hits a jackpot, the casino doesn't panic. They don't close the slot machines. They don't question their system. They don't fire employees. They just shrug, because they know risk is part of the design. They know the gambler might win today, but the house edge guarantees that the casino will win tomorrow, and next week, and next year. The casino doesn't need to win every spin, every hand, or every roll of the dice. It just needs to play long enough. That's the psychology of risk in its purest form. Now compare that to the average trader. A single losing trade can shatter their confidence. A single drawdown can make them abandon their strategy. A single unlucky move in the market makes them think the universe is against them. They expect certainty in an uncertain world, and when certainty doesn't arrive, they spiral. That's gambler psychology. That's the exact opposite of what casinos do. If you want to win in trading, you have to embrace the casino mindset. And that starts with accepting that risk is not a curse, it's your ticket into the game. Every trade you take is a probability, not a guarantee. And once you shift your mind to probabilities, the emotional roller coaster begins to slow down. Suddenly, losses don't sting as much, because they're just part of the distribution. Suddenly, wins don't make you overconfident, because you know they're also part of the distribution. You stop obsessing about the outcome of one trade and start focusing on the outcome of 100 trades. That's when the edge reveals itself. Think about it this way. If you flip a coin once, the outcome feels enormous. If it lands on heads, you might think heads is lucky. If it lands on tails, you might think tails is cursed. But if you flip a coin 1,000 times, the individual flips stop mattering. you start to see the bigger picture. That's what casinos do with gamblers every single day. They don't panic over the one flip. They focus on the thousands. Traders who fail are the ones who treat every flip like it's the end of the world. But here's where it gets tricky. Traders know all of this logically, but they don't feel it emotionally. And in trading, feelings often override logic. You know you should stick to your plan, but the moment you see red on your screen, your survival instincts kick in. You start thinking like a gambler who believes if they just stay one more hand at the blackjack table, they can get it all back. Or, like a gambler who thinks because they lost 3 times in a row, they're due for a win. This is risk mismanagement at its finest. It's the inability to see probability for what it is, because emotions cloud the lens. Casinos protect themselves from this problem with structure. They design games so that no matter how wild the night gets, the numbers will always come back to their favor. The slot machines are programmed with fixed odds. The blackjack tables are set with rules that tilt the edge toward the house. The roulette wheel is built with that single green zero that ensures the casino always makes a little profit over time. They never gamble without an edge. That's why they win. Traders, on the other hand, often gamble without any edge at all. They throw money at the market based on gut feelings, rumors, or impulses. They chase trades out of boredom. They increase their lot size after a loss, hoping to make it back. They decrease it after a win, afraid to give it back. They treat trading like a casino visit where the goal is excitement, not survival. And yet, ironically, if they just acted more like the casino itself, cold, systematic, detached, they'd win far more often. The psychology of risk is also about patience. Casinos don't make their money in one day. They make it over years. They let the math work in their favor. Traders who think they need to double their account overnight fail because they refuse to let probabilities play out. They want certainty today, and the market doesn't hand out certainty today. It hands out randomness in the short term and probabilities in the long term. That's why traders who rush always end up back at zero. Another critical piece of casino psychology is capital preservation. Casinos never risk their entire bankroll on one gambler. Imagine if a casino bet everything on one high roller winning or losing, it would go bankrupt the moment luck went against it. Instead, casinos spread risk across thousands of players, thousands of bets, thousands of games. No single outcome can take them down. Traders often make the opposite mistake. They put half their account on one trade. And when that trade fails, they're out of the game. They risk everything on one spin of the wheel. That's gambler thinking. The market will always tempt you into that mistake. It will whisper that this setup is perfect, that this time is different, that you should go big right now. But the psychology of risk requires you to resist that voice. To think like a casino, you must design your trading in such a way that no single outcome can destroy you. That means risking small per trade, protecting your bankroll, and trusting the long-term math of your edge. It feels boring. It feels slow. But that's exactly how casinos became billion-dollar empires. And here's another truth. Casinos don't need to win every day, and neither do you. A casino can have a bad night. They can have gamblers walk out with millions. But because their system is sound, they keep playing. And eventually, the edge pulls them back into profit. Traders who panic after one bad day lose the chance to let their edge work. They quit too soon. Or worse, they change strategies constantly, never giving probabilities enough time to reveal themselves. The psychology of risk is about detachment. It's about understanding that trading is not a test of your worth, your intelligence, or your luck. It's a test of your ability to manage uncertainty. If you tie your identity to every trade, you'll crumble. If you see each win as proof that you're a genius and each loss as proof that you're a fool, you'll ride an emotional roller coaster that destroys your account. But if you approach risk the way casinos do, with neutrality, with structure, with consistency, you'll finally step off that roller coaster. Think about it like this. Gamblers chase outcomes. Casinos chase process. Gamblers ask, "Did I win today?" Casinos ask, "Is my system working?" That's the key difference. And that's why one group is broke and emotional, while the other is calm and rich. Trading, at its core, isn't about predicting the future. It's about surviving uncertainty long enough for your edge to play out. If you can rewire your psychology to embrace that fact, to accept risk as the cost of doing business, to manage it with discipline, and to detach from the outcomes, you'll no longer feel like a gambler hoping to get lucky. You'll feel like a casino, patient and inevitable, watching the edge compound over time. That shift in mindset changes everything. It removes the fear of losing. It removes the desperation to win right now. It allows you to trade with clarity instead of chaos. And once you start thinking like a casino, you'll realize something powerful. Risk isn't something to be feared. It's something to be mastered. And once you master it, the market stops being a place of danger and becomes a place of opportunity. The deeper you go into trading, the more you realize that most people aren't losing because they lack knowledge. They aren't losing because they can't read a chart, or because they don't understand candlesticks, or because they don't know what a moving average island. They're losing because their psychology of risk is completely wrong. They're wired to think like gamblers when what they really need is the cold, mechanical brain of a casino. This misunderstanding begins with how traders define risk. The average trader thinks risk means losing money. They fear that, so they obsess over avoiding losses. They cut winners short, they move stop losses further away. They hesitate to pull the trigger because they don't want to be wrong. But risk isn't about avoiding losses. Risk is about managing exposure in such a way that the inevitable losses don't matter. Losses are baked into the system. Casinos understand this perfectly. A slot machine doesn't panic when it pays out a jackpot. It doesn't cry when someone walks out with more money than they came in with. The machine just keeps spinning, because the math behind it guarantees profitability over time. The casino doesn't fight losses, it embraces them as part of the plan. And that's exactly how traders should think. But instead, most traders treat every loss like a personal attack. They question themselves, they question their system, and they jump to new strategies in search of the holy grail that will let them avoid losses altogether. The irony is that this desperate chase only creates more inconsistency, which compounds the risk. It's like a gambler who switches tables every few minutes because they think the next table will finally be hot. That's not risk management, that's chaos management. Here's the brutal truth. Gamblers misunderstand probability because they focus on the short term. A gambler believes in streaks. They believe in hot hands, lucky numbers, and magical runs of fortune. But casinos know better. They don't care about streaks. They don't care about one person winning 10 times in a row. Because they know that over thousands of hands, thousands of spins, and thousands of plays, the math never lies. The edge always prevails. Traders who succeed adopt this same long-term vision. They stop obsessing over today's results and start asking themselves, what happens over the next 100 trades if I execute consistently? That's the casino mindset. That's the psychology of risk that separates amateurs from professionals. But this mindset isn't easy to cultivate because humans aren't wired for probabilities. We're wired for emotions. We remember the pain of losses more vividly than the joy of gains. A gambler who loses big will keep replaying that moment in their head, feeling the sting of it, even if they win afterward. That pain drives irrational decisions. In trading, this shows up as revenge trading, over-leveraging, or abandoning plans altogether. The fear of loss and the hunger for immediate recovery are the biggest killers of trading accounts. Casinos are immune to this because they aren't human. They don't feel pain, they don't feel anger, they don't feel fear. The slot machine doesn't care if it loses a round. It doesn't get impatient. It doesn't double its bet size to get even. It just follows the programmed odds with mechanical precision. That's why it wins. The only reason a trader fails is because they let emotions override the numbers. They let their gambler psychology take the wheel. And once that happens, the outcome is inevitable. Disaster. Think of it this way. If a casino suddenly decided to behave like a gambler, it would collapse overnight. Imagine a casino manager panicking after a player hits a jackpot and shutting down all the slot machines. Imagine them changing the rules of blackjack mid-game because they lost too much money to one group of players. Imagine them betting the entire casino's bankroll on one spin of roulette to get it all back. It sounds absurd. And yet, that's exactly what traders do every day. They panic, they deviate from their system, and they risk everything on one or two trades out of frustration. The psychology of risk requires building discipline strong enough to resist these impulses. It requires training yourself to think in terms of large numbers instead of individual trades. When you do this, a losing trade no longer feels catastrophic. It's just one small part of the bigger picture. A winning trade no longer makes you euphoric. It's just another expected outcome within the distribution. You detach. You become the house. Another thing gamblers fail to grasp is the concept of risk-to-reward ratios. Casinos always structure their games so that the potential payout never outweighs the house edge. For example, even if a slot machine pays out 95% of the money put into it, that 5% edge is enough to make billions over time. The gambler doesn't notice the edge because they're blinded by the flashing lights and the possibility of a big win. But the casino doesn't chase the big win. It chases the small edge. That's all it needs. Traders should be thinking the same way. Instead of trying to hit a home run on every trade, they should be aiming for consistent setups where the math gives them a favorable return over time. Maybe they risk $100 to make $200. Maybe they risk 1% of their account per trade to target 2%. That's the trading equivalent of the casino edge. But most traders flip that logic upside down. They risk $500 to make $50. They take tiny profits and massive losses. They're playing a rigged game where they are the gambler, not the house. And the market, like the casino, always collects its due. Another dangerous trait of gambler psychology is the obsession with being right. Gamblers believe that if they guess the lucky number correctly, they're brilliant. Traders often fall into the same trap. They tie their identity to the outcome of a single trade. If the trade wins, they feel like a genius. If it loses, they feel worthless. This emotional attachment distorts their ability to see risk objectively. Casinos, on the other hand, don't care about being right. They don't need to predict whether a gambler will win or lose on a single hand. They only care about the edge. The prediction doesn't matter, the math does. That's the mindset that allows them to stay calm and profitable. Here's the paradox. The more a trader tries to control outcomes, the more they lose control. They overthink, overtrade, and overleverage because they want certainty in a world that doesn't provide it. But the psychology of risk isn't about control, it's about surrender. It's about surrendering to the randomness of the short term while trusting the consistency of the long term. It's about understanding that the market doesn't owe you anything, and that no single trade will make or break you if your system is sound. This is why the best traders don't feel much during a trade. They're calm, detached, almost bored. They know the outcome doesn't matter because they're thinking like casinos. They've trained their psychology to treat every trade as just another spin of the wheel, just another coin toss, just another event in a long series where the edge will always carry them forward. But to get here, you have to rewire your brain. You have to kill the gambler inside you. You have to let go of the fantasy that you'll beat the market by being clever, by catching every move, by outsmarting randomness. That fantasy is what keeps gamblers feeding slot machines until they go broke. The reality is far less glamorous but far more rewarding. You win by being systematic, disciplined, and patient. You win by being boring. You win by thinking like a casino. Risk becomes your friend once you think this way. Instead of fearing losses, you accept them as the cost of doing business. Instead of chasing wins, you let them come naturally as part of the probability distribution. Instead of tying your identity to outcomes, you tie it to process. And in doing so, you shift from being a gambler at the mercy of chance to being a casino that thrives no matter what happens in the short term. This is the essence of the psychology of risk. It's not about eliminating uncertainty. It's about learning to live with it, even to thrive on it, because you've structured your trading so well that no single event can break you. When you get to this point, the market stops feeling like a battlefield. It starts feeling like a business. And just like the casino, you'll realize the only thing you need to do to win is keep playing your edge long enough. If you've followed this far, you already know that the real battle in trading has nothing to do with charts, indicators, or even market knowledge. The real war is waged in your mind, and at the center of it is how you perceive and manage risk. This is where most traders stumble. They look at risk as an enemy, something to be feared, avoided, or eliminated altogether. But the professional trader knows better. Risk is not the enemy. Risk is the business itself. Without risk, there is no trading. Without uncertainty, there is no edge. The psychology of risk is strange because it forces you to hold two opposing truths at once. On one hand, you must accept that every trade you take could lose. On the other hand, you must trust that over a large enough number of trades, you will come out ahead if your edge is real. Most traders can't hold these two truths simultaneously. They get stuck in the short term, obsessing over the outcome of the next trade, the next candle, the next setup. This obsession traps them in gambler thinking. They begin to believe that the next spin of the wheel determines everything, instead of understanding that the wheel has to spin thousands of times before the edge reveals itself. Think about the psychology of a casino. The manager doesn't pace nervously in the back office, wondering if the next player at the roulette table is going to win. They don't slam their desk when a slot machine pays out. They don't question their entire business model after a blackjack player hits a lucky streak. They remain calm because they know what matters is not one game or one night, but the flow of hundreds of thousands of games played across weeks, months, and years. That's how they think about risk. To them, risk is not a threat, it's a revenue stream. Now compare that to the average trader. The moment they take a loss, they panic. They change their system, they move their stop, or they double down to get even. The psychology is completely inverted. Where the casino expects losses and has already factored them into the plan, the trader treats losses like accidents that need to be avoided at all costs. But losses are not accidents. They are built into the structure of the game. Just like a casino cannot operate without payouts, a trader cannot succeed without accepting losses. The problem is never the loss itself, it's how you respond to it. This is where most people fail because they confuse risk with danger. Danger is when you stand to lose more than you can afford. Risk, when properly managed, is simply the cost of participation. A casino knows the difference. They never risk more than the business can absorb. A blackjack table doesn't let you bet the deed to the building. The rules cap the maximum risk because the house understands that survival comes first. But in trading, too many people ignore this principle. They risk half their account on a single trade. They over-leverage because they're desperate to get rich quickly. And when it inevitably fails, they don't just lose money, they lose the ability to keep playing. This is the biggest distinction between gamblers and professionals. Gamblers think in terms of one bet, one spin, one outcome. Professionals think in terms of a lifetime of outcomes. This shift changes everything. When you adopt the long-term view, risk stops feeling like a threat and starts feeling like part of the system. You no longer obsess over being right or wrong on a single trade, because you know that being wrong is built into the plan. You no longer panic after a losing streak, because you know streaks are part of probability. You no longer crave certainty, because you realize certainty doesn't exist in markets, only probabilities do. There is an emotional freedom that comes with this mindset. Imagine the relief of no longer caring whether the next trade wins or loses. Imagine being able to execute with calm precision, knowing that the outcome is irrelevant to your identity, your self-worth, or even your long-term profitability. This is how professional traders live. They don't get euphoric when they win, and they don't get devastated when they lose. They simply execute their edge, trade after trade, like a casino running its games. The paradox is that most traders never experience this freedom because they never stick to one approach long enough to see it work. They quit after a few losses. They switch strategies. They chase new systems. Each time, they reset the clock and put themselves back into gambler mode. The casino never does this. Imagine if a casino tore out all its slot machines because someone hit a jackpot. Imagine if they replaced all their games every week in search of the perfect one. It would be chaos. The business would collapse. And yet, that's exactly how traders behave when they abandon their system after a few losses. They think they're protecting themselves from risk, but in reality, they're creating the very instability that destroys them. The truth is that the market doesn't punish you for taking risk. It punishes you for mismanaging it. That's why traders who understand the psychology of risk can thrive in the exact same markets where others go broke. It's not about predicting the market better, or having some secret indicator, or timing the perfect entry. It's about structuring your approach so that even when the randomness of the market goes against you, you survive. You keep playing. You stay in the game. Consider this. A casino's edge might be as small as 2% or 3% on a game. That means in the short term, players can absolutely win. But the casino doesn't panic, because they know that over thousands of plays, that 2% edge compounds into millions of dollars. A trader might only have a small edge too. Maybe their system gives them a 55% win rate with a favorable risk-to-reward ratio. That edge is enough to build wealth over time, but only if they think like the casino. Only if they're willing to stomach the randomness of the short term and let the probabilities play out. This requires mental toughness. You will take losses. You will face drawdowns. You will question yourself. The gambler inside you will scream for certainty, for control, for instant results. But your job is to silence that gambler and replace it with the calm, methodical patience of a casino. You don't need to win today. You need to stay alive today so you can still be playing tomorrow. That is the essence of professional risk psychology. And here's the most liberating part. Once you truly internalize this, trading stops being stressful. It stops feeling like an emotional roller coaster. You stop checking your phone every 5 minutes, sweating every tick, living and dying by every candle. Instead, you detach. You accept that the outcome of any single trade is meaningless. What matters is the next 100 trades, the next 1,000 trades. What matters is executing your system with consistency. Once you get here, you've broken free from the gambler's prison. You've stepped into the mindset of the casino. This is why the psychology of risk isn't just about numbers. It's about identity. Do you see yourself as the gambler chasing wins? Or do you see yourself as the house, patiently waiting for the math to play out? One identity is fragile, constantly at the mercy of emotion and chance. The other is unshakable, built on discipline and probability. This choice defines your trading career more than any strategy ever will. Risk doesn't disappear when you adopt the casino mindset. What changes is your relationship to it. You stop fighting it. You stop fearing it. You start working with it. You realize that risk is the price of admission to the game, and that if you respect it, it will reward you with longevity and consistency. That's when trading stops being a gamble and starts becoming a business. And when you finally make that leap, you'll understand why the casino never loses in the long run, and why you don't have to either. When you look back at your trading journey so far, you'll probably notice a pattern. The times when you felt most stressed, most emotional, most desperate, were the times when you forgot that trading is a game of risk. You thought you were supposed to win every trade. You thought the market owed you profits because you studied harder than the next person. You thought that losses meant failure, that a losing streak meant you were broken, that one bad trade could erase your identity as a trader. And because of these thoughts, you acted like a gambler instead of a professional. But the truth is this: traders don't lose because the market is too difficult. Traders lose because they can't handle risk correctly. They treat risk like a wild animal to be tamed, instead of like the oxygen that keeps their business alive. They either fear it so much they avoid taking trades altogether, or they disrespect it so much that they blow up their accounts. And both paths lead to the same outcome: quitting. The professional trader understands something different. They know that risk is not the enemy, it is the very structure of the game. Without risk, there is no profit. Without uncertainty, there is no edge. Every winning system is built not on eliminating risk, but on managing it in such a way that the trader survives the inevitable randomness of the market. The psychology of risk is not about pretending you're invincible. It's about admitting you're vulnerable and building a process that keeps you safe anyway. Think about a casino again. The house doesn't fear when a player wins. They don't panic when someone hits a jackpot. They don't question their system when they have to pay out. Why? Because they've built their business model around risk. They expect losses. They welcome them, because they know those losses are temporary blips in the flow of thousands of games. The edge always wins in the long run. That's why the casino stays open year after year while gamblers come and go. This is exactly how your trading should be structured. You are not here to win today. You are not here to hit a jackpot. You are here to build a business, and that business is built on risk. Each trade is just another spin of the wheel, another hand of cards. It doesn't define you, and it doesn't decide your future. What decides your future is whether you respect the probabilities long enough for your edge to show up. The hard part is retraining your brain to think this way. Humans are wired for short-term survival, not long-term probability. We crave certainty. We want immediate feedback. We want to know right now if we're winning or losing. That's why so many traders check their charts every few seconds, why they obsess over one red candle, why they sabotage themselves after a small loss. The brain screams for control, but the market gives none, and so the trader either panics or overreacts. The breakthrough comes when you stop trying to control the market and start controlling yourself. That is the essence of risk psychology. You will never bend the market to your will, but you can bend your habits. You can master your discipline. You can decide that no matter what happens, you will never risk more than you can afford. You can decide that you will execute your plan even when you don't feel like it. You can decide that no single trade matters, because your business is not about one outcome, it's about hundreds of outcomes stacked over time. Once this sinks in, trading becomes peaceful. Not easy, but peaceful. The stress fades because you no longer measure your worth by the last trade. The fear disappears because you know survival is always within your control. The greed subsides because you realize you don't need to win it all today. You begin to operate from a place of calm detachment, where the market is no longer an opponent but a playing field. You stop chasing certainty and start playing the probabilities. That is when you step into the mindset of the professional. And here's the most important truth. This shift is not about strategy. It's not about finding the perfect indicator, the best entry, or the secret setup. Those things are tools. What matters is the person using the tools. Two traders can use the exact same system. One will fail because they treat every trade like life or death, while the other will thrive because they think like a casino. The difference is not the system. The difference is the psychology of risk. If you want to survive in trading, if you want to move from gambler to professional, you must embrace risk the way a casino does. Expect losses, budget for them, respect them, never overexpose yourself. Never treat one trade as more important than the flow of trades. When you build your identity around being the house, not the gambler, you flip the script. You stop being the one feeding the system, and you become the system itself. This is the final shift, the one most traders never make. They read about risk management, but they don't internalize it. They still secretly believe they can avoid losses, or they fantasize about finding a strategy that wins 100% of the time. That fantasy keeps them trapped in gambler thinking. And so they bounce from system to system, blowing accounts, repeating the cycle, never seeing that the solution was never about finding certainty. The solution was about embracing uncertainty. The professionals know that risk is not something you escape. It's something you live with, like gravity. You don't fight gravity, you build airplanes that work with it. You don't escape uncertainty, you build systems that thrive within it. That is the psychology of risk. That is how you stop being the player and start being the house. And here's the beauty. Once you embrace this mindset, you no longer fear the market. You no longer fear losses. You no longer fear the unknown. You respect it, you manage it, and you use it to your advantage. That's when trading stops being gambling and becomes a profession. That's when you finally understand that the real game is not about predicting the next candle, it's about thinking like a casino. So as we close this journey, ask yourself honestly, are you trading like a gambler or like the house? Are you still chasing certainty? Or have you accepted the chaos? Are you measuring your success by one trade or by the consistency of hundreds? Your answer will define the kind of trader you become. Because at the end of the day, the market doesn't decide whether you win or lose. Your relationship with risk does.